So Cathie Wood is one of the most successful investors over the past 6 years. Her fund, the Ark Invest ETF, it's hammered nearly every competitor since its launch in 2014, somehow offering investors a ridiculous yearly return of nearly 30%. And I mean, Cathie herself, she's consistently made headlines for her boldly bullish predictions about the Tesla share price. In fact, while Tesla was under $200 per share, she was there calling for a $4,000 share price. Everyone called her crazy, but even today, after some volatile swings, Tesla, the share price is just under $400. And when we adjust, because they recently split the stock in 5, it comes out to nearly $2,000 per share, around 10 times the price when she was making headlines for her prediction. So with Cathie's unique approach to investing and her somewhat incredible performance over the past 6 years, well, it's fair to say she's ruffled a few feathers in the traditional world of investing. And in this video, we're going to be looking at 3 lessons that she implements with her investing, which have contributed to her somewhat incredible performance. And we're going to take a look into the specific companies which she's been investing into. Hopefully, we can pick up a few tips off her. Now, before I break down her investing strategies, I do want to make something very clear. Firstly, I'm not a financial advisor and this isn't financial advice. Like I always say, I am just a regular guy researching this stuff, really to get my own head around things, and then I'm just sharing that research with you. The other thing we do have to consider is that the Ark ETFs, Cathie's funds, well, they launched in 2014, and that was during a bull market. So while we've had a pretty rough year so far, we haven't seen how these funds would perform in a sustained market downturn. So let's bear that in mind before we get carried away. For me, what I do really like about the companies that Cathie invests into, though, is that they're all based on innovation. Basically, seeing how the world is today, imagining how it will change over the coming years, and then betting on the companies who are best placed to carry out that change. Even though the stock market will, of course, have ups and downs, innovation is something that is never going to stop. And the companies who then carry out such innovation should, in theory, be profitable in the long run. I mean, there will be some ups and downs, like I say, but if you're looking on a long-term horizon, this is how I tend to think. And if you want proof of this, look no further than the most valuable companies in the world today. They're all based on technology and the internet, and they've come really from virtually nowhere to where they are today, and most in just the last couple of decades. So let's look at Cathie's approach to investing. She's launched 4 ETFs back in 2014. We have the Ark Invest ETF, and this is the most general of all of them, and it really covers a variety of things, including robotics, genetics, and autonomous vehicles. Then you have the ETFs, which are more specific to individual niches, such as the Autonomous Technology and Robotics ETF, the Ark Next Generation Internet ETF, the Genomic Revolution ETF, and last year a 5th ETF was launched focusing on fintech, the Ark Fintech Innovation Etf. The premise behind these ETFs was to identify companies that are overlooked by traditional sector-based strategies. So essentially the way that traditional investors work is that they look at things based on sectors. So for example, you have car manufacturers. Historically, they just produce and they sell cars. I mean, it's pretty simple. They have a certain cost per car they make and they have a certain profit per car they sell. If they sell more cars, they make more money. If they sell fewer cars, they should make less money. However, what happens when technology begins to enter into the car industry? And we have companies like Tesla who aren't really just building cars anymore. They're also building an autonomous taxi service. And on top of, you know what? In fact, let's just hand it over to Cathie and she's going to explain it a hell of a lot better than I ever could.
Technology is seeping into every sector. So it's blurring the lines between and among sectors. And the 5 innovation platforms that we're focused on, they're converging. So we need analysts very comfortable with technology, even in the healthcare field and the industrial field. And we need their responsibilities to be broken out by innovation platforms that cut across economic sectors. So a stock like Tesla, now being analyzed in the traditional world by auto analysts, which are analysts focusing on a very mature industry. They're value analysts, right? So price to book, dividend yield, all of those metrics are important to them, are going to find it difficult to analyze a company that is not just an auto manufacturer, but also an artificial intelligence chip designer and an autonomous taxi platform provider, which is a transportation as a service. So we've got 3 analysts focused and collaborating on understanding how Tesla is going to evolve during the next few years. Sam Corris, who does our robotics work, autonomous vehicles are going to be robots. He also does our energy storage work. So he's very comfortable with battery technology. Probably, I would say he's the financial industry's expert on battery technology. We have James Wang, who's focused on artificial intelligence. He came out of NVIDIA, which is the artificial intelligence chip company. So he spent 9 years there, so great expertise, and understands how significant Tesla's latest chip design, artificial intelligence chip design is, pushing it 4 years ahead of anything that NVIDIA is doing right now. And then we have Tasha Keeney, who is using their inputs and pulling together our autonomous taxi network model. And the autonomous taxi network model is a very profitable model. The gross margins there are in the 80% range. The gross margins for auto manufacturers are in the 20 to 30% range, night and day. So you need a completely different kind of analyst and a different way of thinking about the world. No longer sectors, but platforms.
So as Cathie describes it, technology is really blurring the lines between sectors and making it harder and harder to say a company fits neatly into just one sector. However, when it comes to technology and innovation, these things do not happen overnight. And that's why the first strategy that Cathie uses is to focus on the adoption curve of technology and be willing to hold a company for a long time in order to see results. Now, when it comes to investing for the long term, well, this is something I am completely in agreement with. For the absolute professionals, I think short-term investing is difficult enough for them. For people like us, short-term investing, I think, is just a fun way to lose your money in some ways. Like they say, it's about time in the market, not timing the market. And that means really holding for the long term. But what do we mean when we say about the technology adoption curve? Well, this is really interesting. Essentially, Ark has identified 4 key phases in technology adoption. Phase 1 is the long flat adoption curve. During this phase, a lack of understanding is the main cause behind the delay in the acceptance of innovation. Phase 2 is the decline before mass market acceptance. In other words, the investments actually drop in value before they grow. Ark is attributing this to the market's tendency to overestimate the impact of short-term events and to underestimate the long-term trend of disruption. So this is something I've spoken about with you numerous times in the past, how people really tend to, they overestimate the short-term impact that technology is going to have, but they also underestimate the long-term impact. I mean, if you want an example, just look at people's expectations in 1999 about how the internet would change the world in a few short years. Obviously, it took a lot longer than this, meaning they overestimated the short-term impact. On the flip side, though, in the years after the initial hype, I mean, I really doubt that many people would have expected it to change our lives as much as it has today. People overestimate the short term and they underestimate the long term. Phase 3 is an ever-expanding market. Truly innovative companies can reach a mass market and grow their market share beyond any Wall Street projections. Phase 4 is continued evolution and differentiation. As companies mature, they can in turn be disrupted themselves if they don't reinvest in the future. So by looking for companies that don't neatly fit into any one sector, Ark has portfolios that look kind of odd to most traditional investors, but that is done intentionally as they believe the biggest opportunity exists when a company spans numerous sectors. I mean, for example, whatever you may think of Tesla as a company specifically, I think it should be clear that any company building autonomous vehicles that can rival Uber in the future and have interest in developing advanced battery and robotic technology, Well, I would say that that company has a lot more upside potential than a company who just manufactures cars. I'd say, to be fair, the risks are probably higher too, hence you see such crazy movements up and down with the likes of Tesla, but again, the potential returns are higher. Now, let's look at the second lesson when studying Ark's portfolio, and we're going to look at the specific companies that appear most commonly in their investments across those 5 ETFs. And I think this is really quite interesting as it gives us an insight into the individual companies and allows us, if we wish, to go and research those individual companies. So the author of this article has pulled data from all 5 of Ark's ETFs to identify the top 10 holdings. Perhaps unsurprisingly, considering Tesla's incredible run over the past couple of years, it ranks in #1 position with a total of 8% of their holdings. Second is Invitae, a company specializing in genetic testing. Third is Square, a payments and financial services company. Fourth is CRISPR Therapeutics, who are focused on gene modification. Fifth is Roku, a company offering a variety of products in the field of TV entertainment. Sixth is 2U, an online education platform. Seventh is Illumina, one of the leaders in DNA sequencing. Eighth is Zillow Group, a real estate listing and investing platform. Ninth is Compugen, a drug discovery and development company. And finally, in number 10 is Editas Medicine, a leading gene editing company focused on developing CRISPR medicines. As noted, an important recurring theme in this top 10 is the genomic revolution. In other words, companies that are focused on things like the discovery of influential genes or editing those genes once found. In fact, 5 of the top 10 companies, Invitae, CRISPR Therapeutics, Illumina, Compugen, and Editas Medicine, are focused on exactly this. And it's not exactly every day that you see a portfolio where 5 of the top 10 companies are focused on genes. And I find this really particularly interesting because when I listen to how Cathie talks about formulating her investing thesis, which is really by analysing when the cost of a technology has dropped to the point where it could be on the precipice of going mainstream, well, for me, that really resonates with me. So when I see her investing so heavily in gene-related companies, I take that as a pretty good indication that people who are simply so much smarter than myself are willing to put their money where their mouth is. And remember, people tend to overestimate the short term and underestimate the long-term impact when it comes to technology. So with this, when CRISPR, for example, was first used and shared with the world, my research on it is that people were incredibly excited and cautious about how it was going to change the world in just a small number of years. Many years later, it's clear that people overestimated the short-term impact. Well, if we think about it logically, there would come a time, many years after its first use, where the costs would drop to the point where it truly can achieve mainstream adoption. And if we follow the classic rule, well, in the years leading up to this mainstream adoption, people would naturally underestimate it. Now, I'm not a geneticist, and there's really no benefit of me sitting here and quoting an article I found online on the topic of gene editing that I barely even understand myself. There's no point to you. But what I think is much more interesting is when you see people who have been right about things in the past, as Cathie has, and she's working with some top geneticists, and those geneticists are telling her that the time is right to invest now. I think that's fascinating, and that's why I'm bringing you this video, as I think, to tell you the truth, Cathie and the team at Ark, I think, are some of the smartest investors around. And of course, like I said at the beginning, they haven't been through a full up and down cycle, so we don't know how that would play out, but I do still think these guys are some of the best investors around at the moment. Now let's take a look at the third lesson. The author of this article basically decided to look at the stocks which appear the most across the 5 Ark ETFs. So the list before was the top 10 investments based on the amount invested. This time it's simply a case. Does a stock appear in 1, 2, 3, 4 or 5 of their ETFs? And what that brings us to is this list. What I find really interesting here is that there are some big names such as Apple, Amazon and Facebook. even though they may represent smaller portions of the portfolios than the likes of Tesla or Square, it's interesting that Cathie and the team at Ark are not overlooking the biggest companies around. Clearly, she thinks that even the largest companies are capable of innovating and growing further. And on top of this, the typical number of holdings in Ark ETFs are between 39 and 49. Now, that is a very good level of diversification, which of course, I think is a key factor, but especially really if the largest investments are into more risky companies. I mean, when we look at something like gene identification and gene editing, for example, I think it's fair to say that there is a very high degree of risk. Now, of course, if those companies are successful, the potential profits could be huge. But through diversification, she isn't just relying on one company. Even if most of them are not successful, she probably only really needs one of them to work out to get a great overall return. I'd love to know what your thoughts are though. Let me know what you think about Cathie's approach in the comments section. Do you think that it's a potential winning long-term approach, or do you think we have to see a full cycle to really judge it? Before you go, don't forget to check out this video up here, and of course, just thank you for watching.